Another player in the regulation of the financial institutions is the Federal Trade Commission. And the FTC developed safeguards rules to regulate those institutions that are not regulated by other banking agencies or the SEC. This could include mortgage brokers and retailers offering credit to customers, or customer reporting agencies as well. The FTC did not pass detailed safeguard rules, so there is some latitude in how a program will be implemented and maintained. However, the FTC has been quite aggressive in its enforcement actions. The safeguards rule requires companies to develop, implement, and maintain a comprehensive written information security program, which designates an employee to coordinate the program, identifies reasonable and foreseeable internal and external risks, implements safeguards and conducts regular assessments, contractually requires third parties to comply with the safeguards rules, and regularly evaluate and adjust information security policies and procedures. We'll look at several cases that have involved the FTC. In the matter of Acronet, Acronet assembled consumer reports for the three major consumer reporting agencies. Reports contained sensitive non-public personal information and were sold to mortgage brokers and were therefore subject to the FTC's safeguards rules. In 2007 and 2008, hackers accessed nearly 700 consumer reports. This was through vulnerabilities in Acronet's clients' networks. After the breach, Acronet did not take steps to prevent similar incidents. So the FTC cited them for violations of the safeguards rules. Specifically, they didn't implement adequate customer information safeguards or test and monitor their information security controls, evaluate and adjust information security program to increasing risks, and did not develop comprehensive information security program that would be able to protect customer data. In the matter of James B. Nutter and Company, James B. Nutter makes and sells residential loans, thus covered by the FTC safeguard rules. It collects sensitive, non-public personal information through a website and a computer network that they collect the data, store it, and conduct their business. An unauthorized individual hacked the network and sent spam, but there was no evidence of theft of the customer data. The FTC noted that the hacker could have accessed the personal information, so they cited James B. Nutter & Co. For violations of the safeguards rules. They didn't develop a comprehensive written information security program that identified risks to personal information. They didn't develop personal information risk controls, or evaluate and adjust the information security program, or oversee their service providers and contractually maintain clauses that they would implement information security safeguards. In a matter of Superior Mortgage Company or Corporation, Superior is a residential mortgage direct lender. They collect sensitive, non-public personal information. And the FTC complaint did not cite any data breach or attack. It was simply that the website only encrypted data in transit and not at rest. So unencrypted data were transmitted in clear text to the headquarters and branch offices. So the FTC cited Superior Mortgage Corporation for not having conducted a security risk assessment, did not implement adequate password policies for access to sensitive customer information, did not encrypt sensitive customer data at rest, nor oversee service providers and contractually obligate them to implement information safeguards. The Fair and Accurate Credit Transaction Act of 2003, or FACTA, was enacted over growing concerns in the financial industry with identity theft. It required banking regulators and the FTC to develop regulations over financial institutions and creditors offering covered accounts, to develop reasonable policies and procedures to prevent identity theft. So what's the definition of a creditor? That's someone who obtains or uses consumer reports directly or indirectly in connection with a credit transaction, or furnished information to consumer reporting agencies in connection with a credit transaction, or advanced funds to or on behalf of a person based on an obligation of that person to repay the loan. Does not identify a creditor as one who advances funds on behalf of a person for expenses incidental to services performed by a creditor. And this was important because that was the exception that took out doctors and lawyers and other people who performed services and basically either assumed the debt of the individual who was responsible for receiving those services, or in essence advanced the funding for the individual to have those services done. The Fair and Accurate Credit Transaction Act also defined covered accounts. And these are accounts offered primarily for personal, family, or household purposes, designed to permit multiple payments or transactions. And examples of this would be mortgage loans, automobile loans, margin accounts, checking and savings accounts, etc. And you must have a written identity theft protection program. And it identifies the red flags or patterns, practices, and specific activities that indicate possible identity theft. There's several pages that list a lot of these red flags in the text, and you should know those. So for instance, if there's a lot of new transactions opened up in someone's banking account, or in their establishing new credit cards or things, it raises a red flag that allows a bank to go back and question whether or not the activity was legitimate or not. So it should detect the red flags and appropriately respond to those flags. And they should periodically update the red flag program.